Hey everybody, it's the weekend recap, our newest episode, and this one, I started this yesterday, and there's a couple of very profound things that I'm going to yesterday in today's video, and we have sound, which is also good. So let's jump in. I'll make this as quickly as possible, but there's a lot of stuff in here that you all need to know, and it's nice to see as well a lot of other research firms looking at the same stuff that I look at too. So let's jump in. Hope everybody's well. Thank you to TD Tesla in the chat. I see Beardy out there. I see Dez. We've got people from all over the world. It's amazing. So I'm here for you guys. So today we're going to talk about Bitcoin, bank runs, contagion, stagflation, and how it all weaves together and why, the stuff that governments say these days and what they do is ludicrous. And it must put everybody on edge, which is actually good for Bitcoin. And we'll show some data points that support that. So first of all, edutainment, hit the likes. A lot of work goes into each and every one of these. We've got to get this message out. That's all I ask. I don't care about likes from me. I don't care about, anything else. But just hit the like so other people can listen to this message. First, we'll look at some Bitcoin stuff. Bitcoin dominance. Over the last 2 years, it's been in this tidy little box, literally bouncing, thank you, KN, between exactly 39.5% Bitcoin dominance and 48.5% Bitcoin dominance. Boom, 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 boom. And the question is, what's really happening? Obviously, we've had a flow from stablecoins into Bitcoin, which has helped Bitcoin dominance. And now, sometimes the altcoins begin to run. A lot of them are crap. People are still YOLOing into them. So it's hard to say where this will go. But if history repeats, it should really struggle at the 49 level. Anyway, looks like we're double tapping that glass. But now people are beginning to see the value of the layer 1s and layer 2s out there. And we'll talk more about that today as well. So let's look at what happened. This was a big week. We had First Republic hit the wall. In full disclosure, that's one of my banks. And what happened, though, is not necessarily about First Republic, but as it did disintegrate, over $200 million worth of Bitcoin was pulled from exchanges in the last 24 hours. And that activity was driven by large whales. So it's like, okay, when the large whales take their Bitcoin off the exchanges, it means they don't plan on trading anytime soon. I don't know if the whales reacted to First Republic or they're just being super, super cautious. But this is a good sign, and this makes, again, Bitcoin a little bit more scarce as we go forward. In addition, let's look at this cool little review that I threw together in a spreadsheet and turned into a little graphic. The best and worst assets year to date. Guess who's at the top of the list? Bitcoin, woohoo. Ethereum number 2, NASDAQ, technology, NASDAQ 100, QQQ number 3, and developed nations without the USA. Number 4. So emerging markets are coming up, and that will tie into what I discussed later. Then you got the S&P 500. Then you got gold underperforming the S&P 500, which goes fly in the face of what people think about. This is the time for a flight to safety. Gold is still underperforming the S&P, which is a problem. And at the very bottom, you got all the all the zombie companies and banks hitting the wall. Signature Bank, Silicon Valley Bank, First Republic Bank, Bed Bath & Beyond, bankrupt. That's been bankrupted with a zombie for 5 years. Credit Suisse, volatility, regional banks, oil, small caps. I mean, the world is quite a mess. And even when you pull apart the NASDAQ 100, it's only 7 companies that are driving the results there too. So watch that space. In addition, a little bit of crypto news. Matic, I did mention in my video yesterday something about this. Not Matic specifically, but how layer 2s were more exposed than some of the layer 1s. And this DeFi protocol AVAX, hope I'm saying that right, was exploited by a flash loan attack that manipulated the price of the asset. The team reached out to the hacker, but the hacker's like, no, I'll keep my, whatever it was, $2 million. Not a lot of money in this day and age with inflation, but again, it's a good little score. Let's talk about some of the other layer 2s, as we're talking about layer 2s, like Polygon. One of them here, Arbitrum, has been eating Polygon alive lately. But the popularity of ETH layer 2s is resulting in an increased adoption of the native protocols. And some of these protocols like GMX, Radiant, Arbitrum are experiencing above market user traction. And that is not only the creation of new tokens can generate positive sentiment among users, but the key is to sustain that energy of this approach. Now, new native tokens need to focus on traditional competitive angles to expand their moats. When you compare things like Arbitrum to Optimism, Arbitrum has done a much better job of retaining customers, especially for native applications. I want you to cast your eye on the Arbitrum chart and the yellow line. That is the uptick in native applications, which is so key to core of this. When you see the Optimism chart and the native applications going down, that is not good. In addition, avalanches from K33 Research, the K33 Vinter Quality Index removed avalanche. And why did they do that? This comes after a reassessment of the expected inflationary pressure and ownership concentration of AVAX. AVAX has a large percentage of tokens outstanding from future supply through rewards and, more importantly, through vesting schedules. Remember tokenomics, that's why we created the compendium. The facts have not changed from February assessment, but K33 believes it has underestimated the expected supply pressure and downward selling pressure of the combination of significant inflation and token unlocks. Hence, AVAX received a boot from their little portfolio. And this is good. It's good to see analysts like this now focus on tokenomics and not listen to what you hear out there. Now, before I go back to this, I made a video, it was like 15 months ago, I think, at this stage. And it's after the head of Avalanche was on Rand's channel. And I couldn't believe what he was saying. So I did a response video. I'll add a link for that up here too if you want to see it. And it's amazing how the stuff that this guy said publicly was so wrong. Now you have other firms like K33 picking it up. And as I mentioned as well in last weekend's Q&A, which is happening again tomorrow, the compendium score, which ranks tokenomics and all sorts of other factors of Avalanche, they scored 23rd out of 24 smart contract platforms. That is a horrific score. Now, the technology and everything itself is good. So we have another thing called the SCP profiler, smart contract profiler. It scores well there, but the tokenomics suck, and that's a problem. Anyhow, this is the Vinter Index, as they call it, and it shows you what they have, and they're far from perfect. They have Bitcoin, ETH, Doge, Matic, Sol, Uniswap, Cosmos, Monero, and Lido. That is what's in their bag, and obviously they just scratched Avalanche out. So interesting to see, and I always like to monitor how other people manage portfolios. So with that, let's jump ahead. Let's talk about Solana Dex Volume. They are back. So if we look at the July to October average DEX volume, 5.5 billion, to January to April, 5.46 billion, called it 5.5 billion too. And that is, we are almost at the same levels before the FTX crash, the big black eye that the Solana blockchain took from being associated with FTX and that complete scumbag. Anyway, not going to dwell on that. The past is in the past. He fooled everybody, including myself, including top members of Congress and politicians and former US presidents, etc., etc. So enough of that, but it's good to see that the DEX volumes are back for Solana. In addition, a little bit of Tesla news before we get into the deep why Bitcoin news coming in a second. Tesla won the Kelley Blue Book, which is a car analyst firm in the United States, the 5-year cost to own award. And that's for premium EVs, etc. But it's not so much that. This analysis was done before the price cuts and before all the other enhancements and extended range, etc. So if they've done so well winning this, I wonder what it's going to look like next year. And by the way, Model Y didn't make it because it's too new a car. It doesn't have 5 years of history. But the Model 3 does. And this is the ranking of the Model 3 in the class of all luxury and how much it costs over 5 years. And you can see the numbers are $43K, which is exactly $7,500 under the next competitor in that same league. And remember, of all of these cars, there is only one EV. So not only is it an EV, but it's also the cheapest for cost of ownership, and it's also a lot cheaper than everything else. Mercedes-Benz, Acuras, Lexus, a lot of Lexus on this list, Genesis, Well, the Model Y is there, actually. I forgot it was in there. The 2023 Model Y. I didn't think it was been around for 5 years, so I wonder how they calculated that. Anyway, I should have seen how to put this together. Anyway, the point is, it is cheap to run and getting a lot cheaper as ICE vehicles amortize faster. You know, when you look at some of these cars, they're going to be worthless in 5 to 8 years completely, and they'll be completely obsolete as well. So that is interesting to share. Now, this is the scary part of the news today. And I know I talk a lot about macro and everything else, but again, it's because all roads lead to Bitcoin. And you have to know this because everybody needs that life raft. But when this came out, I was very irate. And if there's anybody there from the UK in the audience, please rattle your sabers because this is very annoying. Bank of England, Britons need to accept they're poorer, says Bank of England economist. It's like, huh? A guy called Who Pill? He said the British households and businesses need to accept they are poorer and stop seeking pay increases and stop pushing prices higher. You have to stop. Pill said this. It's like you can't make this up. Obviously, the UK is a big importer of natural gas, which they don't control, etc. And these are things that are actually pushing up the price. But he said that this has led to the pass the parcel game, where households and companies tried to pass on their higher costs to each other. And he said this is generating inflation. And this part of inflation can persist. And I can't imagine the criticism that came from these statements. But literally, it's as if he's reading something from the WEF, World Economic Forum playbook. Be poor and be happy, or own nothing and you will be happy, or whatever they say. I can't remember. But that is just stunning. And yes, there are elements that cannot be controlled, but it's not the people's fault. You know, there was an article I read during the week as well that trainee doctors and nurses earn less than people who work at McDonald's in the UK. And these are people that save lives. So it's just, everything is completely out of whack. Now, let's talk about inflation. It is accelerating again, which is bad news. But again, as I say, the Fed and the Bank of England, etc., don't control inflation. They can destroy demand and jobs, but they do not control inflation. So this US inflation measure, cast your eye on the, obviously both going up in Q1, whether you look at the blue, which is the PCE price index, or the white is the PCE price index, excluding food and energy, which is more of a stable factor, but that's even gone up too. And this is at the same time that weekly jobless claims pointed to a still robust labor market. And this all points to a very bizarre situation. Hence, this is happening. Enter stagflation. I made videos that I was expecting stagflation when I forecasted there was about 15% inflation was coming. And that depends on exactly how you really truly measure it. But this is the real concern. And why is it a concern? Well, the US economy, like the British economy, just escaped a recession as well. They had just slightly zero growth. But the US economy grew at a slower pace than expected in Q1 2023. And now everybody's worried about stagflation. Federal Reserve is meeting next week, and they're going to raise basis points, 25 basis points, that's expected too. US is approaching its debt ceiling. The US dollar credit default swap rates are through the roof, less than China. No, more than China. The insurance is higher than China. And Democrats and Republicans are miles apart in raising the debt ceiling, which they have to anyway because we're in a debt spiral. It's going to keep on going up. Deficit's going to keep on going up. There's no coming back to that. And investors are concerned about the potential for default, but we believe the debt ceiling will be extended. Of course, they keep raising it. They always do. It's QE to infinity. No surprise there. But I was trying to pull a very simple example of what stagflation is, and then we'll talk about why it's so dangerous. So this is an example of Johnson & Johnson sales and products, whether they are beauty, grooming, healthcare, etc., family care. You can see the sales are down 3%. If you take into account foreign exchange, sales are down 4%. But the prices are up 10%. That's all you need to know. When prices go up, inflation goes up, and growth goes down, bad. Kiss of death. And this is what the Fed should be really, really worried about. Let me explain why. First of all, this is an example of a canary in the coal mine, as people say. This is from Steno Research. And here you can see Swedish retail sales fell by the most ever in the history of the world. Just in a very short window of time, bitten by inflation, the poor people in Sweden, and I'm sure it's similar in Norway and Denmark and Finland perhaps, but retail sales in Sweden fell 13.4%. And these are catastrophic numbers. If you have thin margins in your business and your revenue falls by nearly 14%, that is really going to hurt. The question is this telling us that there could be a recession? We know there's probably going to be a recession. We could already be one in the US, but what's going to happen in Europe is an interesting case. In addition, this is the problem with all of this debt and stagflation, etc. So debt is a response to productivity gains, which should be flowing to society in the form of lower prices. There's a lot of the Jeff Booth theory of we should have a life of abundance and deflation with technology. However, the productivity gains instead are being stolen and concentrated at the top through manipulation of money. We see exactly that thing happening now in the US. You've got banks like First Republic and other banks, they're hitting the wall. And who's there to pick them up for a zero on the dollar? Or sometimes in the Credit Suisse case, for example, they get like a credit to take it over. JP Morgan, the top money center banks, highest, richest people. They are the ones that benefit, not the average person on the street like you and I. This is the manipulation of money. This is done to prevent deflation, which would cause banks to fail and the entire system to collapse. But banks are failing and the system is collapsing. As a result, we live in a world where debt is already insolvent, but we pretend it's not. And this creates the incentive for everyone to be too big to fail, which leads to the theft as a base layer of money in the economy. This is probably, and I read those 5 little bullets out, the most important bullets I've ever said on YouTube. This explains all of the problem we face today. And as a result, the only way we can survive this is we need an asset that has a higher yield than savings accounts and non-demand accounts. You need something that's more secure investment than fiat, and it's not subject to inflation. This is so critical, so important. And in addition, let's look at some more numbers. And I've been talking about kind of financial Armageddon and the craziness that JP and the Fed are doing and why they're doing it. But they're causing this whole mess because they are now stuck. They have to have inflation so they can somehow control the amount of debt spiral they're in. And at the same time, control who controls the money, control the wealth, and steal from everybody else. Every single chart you look at says the same thing. So this is an example of what happens to the banks. $2 trillion in drainage because of rate hikes. Deposit and savings and non-demand accounts fell by that $2 trillion since the start of 2022. Money is moving into higher rate CDs and time deposits, money market accounts, whatever you want to call them. And it left the banking system for retail money market funds. And the interest rates on these accounts are very low. People need high yield and they need a way to try to keep up with inflation. It is so simple, but people still are not aware of exactly the problem that's happening right now, which is just shocking. And sorry for going off on a rant, but it's so important. If you look at this as well, this is alarm bell time. This is the Federal Home Loan Bank's balance. They provide short-term loans to member banks. And in Q1 2023, the FHLB, the Federal Home Loan Bank fund, hit an all-time high of $1.04 trillion. This is the highest quarterly amount since the Great Financial Crisis. See the chart? It's actually higher than the Great Financial Crisis. And we all know what happened then. The economy is slowing down. The demand for loans has disappeared. Interest rates are rising, which is making it more expensive for banks to borrow money. Then we have stuff in Ukraine happening. And everything's spinning out of control. So this is de facto quantitative easing. It's like a backdoor bailout for the banks, all the trouble that's been caused by the Fed. And I've been saying the same thing for a long time. We've got big banks. First Republic is number 14. Silicon Valley Bank was number 16. The 2 of the top 20 banks, boom, and maybe a third one too. Can't even remember where the third one ranked, Signature. But this is stunning. And they're not alone. There's more shoes to drop. Everybody knows that. Let's look at the amount of cash drained. In the blink of an eye for First Republic, they lost over $100 billion in the space of a couple of weeks. Poof. And that's after pulling in that little green box, $30 billion from other banks, the deposit infusion. And did that help? It wasn't a spit in the bucket. And that is so bizarre. This is the death of First Republic. Again, before the run. And I've been talking about the risk of holding an asset to maturity. But this also applies to mortgage portfolios. They are also destroyed by JP's recklessness and the Fed. This was also clear. So if you have a bank and they have a whole bunch of portfolio mortgages, hundreds of billions of dollars of them, they're at like a 3% fixed interest rate. And the interest rates now for mortgages are nearly 7%. Who's going to buy those mortgages? They don't generate enough return based on the market rate. They're underwater. So this is another way of banks being exposed by the reckless increase in rates. So it's a complete mess. In addition, PNC is bidding for First Republic. Yep, that's another kind of JP Morgan hookup, FDIC, let the bank fail, turns into dust, and another bank picks it up and gets the assets for free. And that's just how it works. Welcome to the world. And the banking system is still stressed. We spoke about Silicon Valley Bank, Signature Bank, Credit Suisse, First Republic, and there's still huge issues. There's still system stress in the banking system for a whole host of reasons. You jack rates fast, things will break, and no ifs, ands, or buts. And that is the message today. But there's more. We're going to talk about the dollar. And, people talk about BRICS. Oh, BRICS, nothing. No, not interesting. But it could be a little bit of a threat. And, Russia are really turning the screws on dollar hegemony, and it's been watched very closely by other countries. And if Russia is successful in reducing the world's reliance on the dollar, it will lead to a shift away from the dollar as the world's reserve currency. And this would have significant impact on the global economy, and it would likely lead to a more bipolar world. It will be the dollar world, maybe dollar-euro world, BRICS world, and everything else. But it's not just BRICS. This is stunning. Somehow, Xi and Putin have a lot of fans, which caught many by surprise. But 19 new countries want in on BRICS. Not just Brazil, South Africa, India, China, and Russia. There's 19 more dying to jump in, and you know who they are. Saudi Arabia, etc. All these old places that have hard resources, hard energies. Which means if the US dollar is not used for international transactions, if other currencies become more popular, it means there'll be less demand from the dollar, which means the dollar value will fall. And I anticipate the Dixie will fall by September 2023. I covered that in Octa on Tuesday as well. So the point is, if you hold dollars like cash, obviously it's debasing, but it could debase in a more accelerated way if these guys pull this off. And things are looking pretty scary right now. In addition, gold is the only option as well for many emerging markets and emerging central banks. And here, hat tip to Sanjay and James Savish for sharing this. Emerging markets stacking gold because they fear their own fiat is really worth nothing and it needs a hard asset behind it. So can you imagine what would happen? And there's already rumblings I spoke about too as well. Russia is mining Bitcoin and other countries are thinking about doing it too. Can you imagine what would happen? Not only the combination of stagflation, dollar debasing, falling faster than normal, global worldwide recession, and then people catch on that there's an alternative to gold. Wow, that'd be bonkers. Anyway, net, the message is, as you know, all roads lead to Bitcoin, everybody. So big thank you for being here. As I said yesterday in yesterday's video, the number go up video of Bitcoin. Time is running out. Everybody, if you don't have any, get a little piece. Urge, if you have friends or family and they're sitting on like $1 million cash sitting in a bank, it's too risky, You can just buy an S&P 500 index. It's just craziness. So tomorrow, live Q&A. I'll be live at noon here, noon Pacific, which is whatever that is in UTC. I don't even know what all this changes. Thank you all for being here. Thank to the mods. Thank you to Aristotle, Plato, and everybody else. And I'll see you all tomorrow. And hit the like on the way. I'd really appreciate that as well. Bye all.